Powell lifts US markets. The AI trade stalls. India Inc. falters, and Alphabet gets my vote. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode 139 of the Stock Doctor podcast. Now, before we start today's show, I've got to make a couple of announcements. All I got to say is after this episode, after episode 139, the Stock Doctor podcast, the show will be going on an extended break. And that is because of two reasons. Number one, yours truly is traveling at the end of this week to visit his family, spend some time with his family. So at the time, I will not be able to, get the time to draft the script, get the script ready and publish. At the same time, I'm also going back to being a student as I buckle down and prepare for my Chartered Alternative Investment Analyst Level 2 exam. So the Kaya Level 2 exam, which is scheduled for next month. So a lot of preparations remaining, a lot of formulas to memorize, a lot of concepts to understand, practice questions, mock exams, all of that. So I'm going back to my student life for about a month. So because of these multiple conflicts, the show will take a pause. But don't worry, we will be back by the end of September. And when we come back by the end of September, it will be a very, very special moment in time for me. Since, I don't know if you remember it, the Stock Doctor podcast would have actually turned 4, by then. So it turns 4 years old. The 4th anniversary of the show is coming next month. So by the time we come back, there will be a special anniversary episode, 4th year anniversary celebration episode waiting for you. So just to let you guys know, there will be a small pause after this, about a month's pause, and then I'm back again end of September when we and we basically pick up where we left off. Right. Before all of that, we still have a show to run today. Episode 139 isn't going anywhere. So let's get straight to it. US markets were all waiting with a bated breath last week for Fed Chair Jerome Powell to deliver his speech at the Jackson Hole Summit in Wyoming. Ahead of the speech, it looked like it would be a very, very down week for the markets as nerves got the better of investors and they were feeling very jittery, and that sometimes it was heading for a red week for sure. However, on Friday, when Chair Powell did deliver what would be his final Jackson Hole speech, remember his term ends next year, and all signs point to the fact that he's not going to be, his tenure is not going to be renewed whatsoever. They already have candidates lined up. It's not happening. So it would be in what was his final Jackson Hole speech. It was nothing but positive news from a rate cut perspective, and that was enough for the markets to rip, with the Dow even ending Friday on a record high. Once the dust had settled, the Dow gained 1.5% for the week. S&P 500 eked out a 0.3% for the week, and the tech-heavy Nasdaq ended the week down 0.6%. Although it would have been far worse had it not been for the Powell positivity. So let me welcome you to the first segment, Doctor's Weekly Snapshot, and take you through exactly what transpired at Jackson Hole, Wyoming, for markets to go from bleeding out to absolutely ripping, all in the space of one trading session. Fed Chair Jerome Powell, in his Jackson Hole speech, hinted strongly at the possibility of interest rate cuts as soon as next month, which is the September meeting, citing worries about a softening US labor market and the inflationary effect of the recent tariff hikes. Chair Powell noted that while the labor market appears stable, there are signs of slowing supply and demand for workers, raising the risks of sharper layoffs and rising unemployment. He also signaled that evolving conditions would warrant an adjustment of policy, opening the door for a rate cut in September, which was enough for the markets to absolutely rip. Now, Chair Powell acknowledged tariffs are visibly pushing up consumer prices, but suggested that inflation may be temporary as supply chains adapt. Remember, he didn't use the word transitory. I didn't think he wanted to jinx it. He didn't use the word transitory, but called it temporary. Same thing, as supply chains adapt, but his main focus on labor market, giving a strong indication that the Fed might be pivoting to a renewed focus on the softening labor market as opposed to the extra emphasis on inflation that they've been doing till date. Now, if you ask me, then Chair Powell is absolutely right to focus on the softening labor market since the conditions are not exactly great. I've already talked to you a couple of episodes back in detail about how the US job market looks like, but we got some data that further confirms that things are not looking good for the US job market. A recent report in the Wall Street Journal showed that although unemployment rate remains low and companies are largely holding on to their workers, a process called labor hoarding, businesses are also refraining from expanding their workforces, making the economy vulnerable to any modest uptick in job losses. For instance, the US hiring rate fell to 3.3% in June, significantly below its pre-pandemic levels of 3.9% and the post-pandemic recovery peak of 4.6%, which we got in November 2021. More people are spending extended periods over 6 months in job searches, reflecting tougher conditions for job seekers. I mean, I may not be in the US, but I can completely empathize with these people who are spending more than over 6 months for job searches. I'm going through the same situation here in the UK, where it's been nearly 7 months since I've been actively searching for a full-time job. It's been nearly 7 months, no luck so far. So I totally empathize with the guys who are spending extended periods in jobs. I'm right in the same boat. Different ocean, different continent, but right in the same boat with these guys. So I definitely do empathize, and I hope things do pick up. But having said that, job market is indeed brutal. That's for sure. At the same time, the layoff rate in June stood at just 1% in the US, close to historical lows seen during the strongest parts of the 2021 job market. While the layoff rate of 1% is great for now, since it explains why unemployment rate remains low, with hiring so sluggish, even a small increase in the layoff rate, such as from 1% to maybe 1.3%, a relatively minor move, could mean hundreds of thousands of more layoffs, which the stalled hiring environment may be unable to absorb. Fed Chair Powell has constantly cited tariffs as the reason why he's reluctant to cut rates, since he believes that tariffs would raise inflation. While theoretically he is right, it hasn't materialized yet. In my opinion, Chair Powell and company should probably be looking at the impact that the tariffs are actually having on the labor market, because that relationship would certainly be, currently certainly leaning towards supporting for a rate cut. More specifically, the Trump administration's tariffs and associated uncertainty have discouraged new hiring. Businesses are sitting back and watching, according to the Dallas Fed's July survey. The sharp rise in interest rates by the Fed, intended to control inflation, has also contributed to the hiring slowdown. And the situation is unlikely to improve anytime soon. Recent surveys suggest 1 in 5 employers plans to further slow hiring in the latter half of 2025, raising alarm bells about sustained stagnation or possible contraction. And economists warn, rightly so in my opinion, that once job losses take hold, a self-reinforcing cycle of layoffs, reduced consumption, and broader economic slowdown can emerge, and that the Fed then may have to rate cuts far more substantially to counteract the downturn. Now, on last week's episode, I did tell you that the Fed was certainly at a crossroads. Jackson Hole indicated that Chair Powell and company have made their choice, in that they're likely to go for a rate cut as their focus switches from inflation to what's going on in the labor market. This would suggest that we do get a rate cut in September, a certain positive for the markets. Now, it might be certain positive for markets, but as investors, we have to factor in a little bit of an additional element as well that has been transpiring in the last week and the week before, which is that the AI trade might finally be slowing down, which does raise the question, if markets are so buoyant about rate cuts, does it mean tech goes higher, or is the great rotation well and truly back? Last week's market action would certainly lead support to the latter, the great rate rotation being well and truly back, as despite a rally sparked by the Fed's signals on rate cuts, tech stocks fell actually 1.6% for the week, lagging behind sectors such as energy, materials, and real estate, which each gained more than 2%. JP Morgan data shows individual investors were net sellers during the week's sharp tech decline, a rare shift for a group that is usually mostly bullish on tech. AI fatigue is certainly kicking in, as well as investors are starting to worry about tech valuations. Now, listen, while I'm not reducing exposure to tech at all, that doesn't mean that you should do the same. I completely understand if you find your big tech positions a bit too oversized for your liking, and given that rate cuts are imminent, now would be a good time to rotate into other sectors if you really want. Having said that, don't forget that this is the week of the earnings Super Bowl, also known as NVIDIA's earnings, set to release on Wednesday after market close. That would be 4 p.m. Eastern time in the US, 9 p.m. UK time, and 1:30 a.m. Thursday morning India time. There you go. Covered all the demographics. So perhaps you might want to hear what Jensen Huang and company have to say before you finally decide if it's time to hit the pause button on AI trade or not. And on that note, let's head now into our next segment, The Doctor Goes Home, where it's going to be actually a truncated trading week in the Indian markets on account of Ganesh Chaturthi on Wednesday. Speaking of which, very happy Ganesh Chaturthi to my Indian listeners in advance. Hope all of you guys have an amazing time with your families and enjoy. Now, this week, I want to talk about two key themes that grabbed the headlines last week. The first was with respect to the recent GST bonanza announced by Prime Minister Modi during his Independence Day speech. More specifically, the Confederation of Indian Industry, CII, released a comprehensive reform blueprint titled Policies for a Competitive India, which recommends over 250 actionable policy changes across 14 critical areas to accelerate India's economic transformation in alignment with Viksit Bharat 2047. Now, while I'm not going to take you through all 250 of these changes, we would be here all day. And honestly, might be the last episode you would ever watch, given the time it would take. One particular element in the report was with respect to the GST and the tax policy. Specifically, CII proposes simplifying the GST structure, expanding its coverage to include currently excluded areas such as petroleum and real estate, and rationalizing the overall tariff structure to enhance efficiency and compliance. This is kind of a blessing for the GST 2.0 reforms, which further increases the odds of the reforms indeed passing through. There are even reports that the government is considering speeding up the timeline of the GST 2.0 reforms, since the inevitable is already happening, which is that consumption is stalling as the Indian consumer awaits for more clarity on the reforms. However, obstacles do remain in this regards, especially given that the reforms have sparked concerns over fiscal tensions between India's central and state governments, particularly due to the anticipated revenue losses and political implications. Now, economists estimate a total annual cost to the exchequer of 1.8 lakh crores, which amounts to $20.7 billion, with states bearing a disproportionate share of the losses, 0.36% of GDP, compared to the federal government's hit of about 0.15. That's more than double. The hit the states have to take. The states have already expressed grievance about insufficient compensation since the GST was rolled out in 2017, with some like Punjab claiming massive yearly losses. Unless this trust deficit is repaired, the Indian consumer will have to wait before enjoying the benefits of the reforms. Now, the GST Council is expected to address the proposed reforms next month or by early October. Major decisions must be approved either by consensus or, if a vote is required, a 3/4 majority. So while the GST 2.0 is certainly worth celebrating, and I do believe the odds of its passage are high, it is by no means a slam dunk. That's the somewhat positive news. That and the fact that the Economic Times poll of 14 economists have now forecasted India's economic growth at 6.7%, which is the median forecast in the first quarter of FY26, slightly above RBI's projections of 6.5%. So that's more good news there. However, there was also very, very concerning news, ladies and gentlemen, for Indian investors, and that was with respect to the Q1 earnings season, which is now officially ended. More specifically, India Inc.'s Q1 FY26 earnings season saw a notable downturn, with 51 previously profitable companies, including the likes of Tejas Networks and Idea Forge, reporting year-on-year losses, marking the fifth consecutive quarter of single-digit profit growth in the broader market. To make matters worse, the BSE posted a modest 9.9% profit growth, sustaining a trend of 5 consecutive quarters with single-digit expansion. Like I said before, revenue, which is the top-line growth, was worryingly muted at just around 7% for both Nifty and the BSE indices. Consensus estimates tracked by Phillip Capital and other brokerages show that EPS downgrades heavily outnumbered upgrades for FY26, 27, and FY28 across the Nifty, with retail and FMCG sectors facing the steepest cuts. This is certainly a cause for concern, since earnings are crucial catalysts that propel stock markets. The numbers I talked about are certainly worrying, and should the negativity surrounding earnings persist, then no reform or macro positives are going to keep the markets buoyant for so long. The festive season is going to be absolutely crucial, especially given the fact that FMCG sectors have faced steepest cuts in rating in EPS downgrades. And it is vital that the government unleashes the GST 2.0 reforms as soon as possible so that the consumption is boosted and which further supports the top line and bottom line growth of India Inc. The overall sentiment is that recovery should begin in second half of FY26. For the sake of investors like you and I, let's just hope that the sentiment is true. On that cautious note, let's now head to the final segment, Dr. Dissects, where it's very ironic that I told you that maybe it's time to move out of the big tech, and yet the company that's going under the microscope this week is a big tech company, one of the constituents of the Magnificent Seven. Hear me out, guys, and then after you're doing your own research as well, see whether you really want to push the pause button or not on the Mag 7 or the AI trade or whatever. The company I'm talking about this week that is going under the microscope is Google parent Alphabet, ticker symbol GOOGL, Google without the E. Alphabet had a good Q2, which was earnings which were released last month, beating on both the top and bottom line estimates once again. Q2 revenues came in at $96.4 billion, up 14% year over year, beating analyst estimates by $2.45 billion. Diluted EPS came in at $2.31, up 22% year over year, beating analyst estimates by 12 cents. Operating margins came in strong at 32.4%, but were flat year on year on account of higher legal costs, with a $1.4 billion charge related to the settlement being the primary driver of operating expenses. Free cash flows for the quarter on account of higher capital expenditures dipped to $5.3 billion, with trailing 12-month cash flows coming in at $66.7 billion. While management didn't provide any specific outlook, they did provide commentary on what to expect for the rest of the year and for 2026. The key takeaway from the commentary is that the company plans to raise its capex spending to $85 billion from the previous guide of $75 billion. Management cited strong demand for the company's cloud products and services as the primary reason behind raising capex spend. More specifically, CFO Anat Ashkenazi cited additional investment in servers, the timing of delivery of servers, and an acceleration in the pace of data center construction as the factors behind the $10 billion jump in capex spending. Management also announced that higher depreciation on account of significant increase in capex would act as a headwind to profit and loss. Finally, with respect to headcount, management announced that they would see a sequential increase in total headcount in Q3. Now, there have been a lot of claims in recent times that with the advent of AI models such as ChatGPT and Perplexity AI, it would be curtains down for Google's search business. Q2 proved that these claims may have been exaggerated. The company's AI overviews have certainly proved to be popular and are driving higher search usage. Management announced that AI overviews now has over 2 billion monthly users across more than 200 countries, and the feature is available in 140 languages. Management also reported that AI overviews drove a 10% increase in search usage in Q2, which demonstrates that the company is leveraging AI to maintain its search dominance, despite facing one of the most challenging competitive landscapes in recent memory. Moreover, the company's newly launched AI Mode has over 100 million monthly active users, despite being only launched in the US and in India. All of these developments ensured that the search business not only went back to double-digit growth on a year-over-year basis, but also comprehensively reversed its sequential decline that it witnessed last quarter. Of course, one quarter doesn't make a trend, just like how one bad quarter doesn't make one either. However, the progress made by AI overview certainly suggests that the growth potential of the search business continues to remain strong, albeit not as bulletproof as it was in the past. Moreover, it is also encouraging to see Google's AI features are ensuring that the search segment is maintaining its popularity amongst younger users. For instance, the combination of lens or circle to search, along with AI overviews, saw strong traction amongst younger users. Now, the traditional way of searching via Google may no longer be the trend in the age of AI. However, the fact that Google was able to transform its search business using its AI features certainly bodes well for the company's future and suggests that the demise of the company's search business may have been exaggerated. The last onto the next takeaway. That last time I talked to you guys about Alphabet, I mentioned how in the previous quarter, YouTube had reached a historic milestone when it celebrated its 20th birthday. At the time, data from Nielsen had shown that the platform accounted for 12% of the total TV watch time, which was a new record. This quarter, no different. Latest Nielsen data showed that consumers watch YouTube on TV more than on their phones or any other device, with an average of more than 1 billion hours each day. This viewing time is more than the total viewing time on Disney's broadcast network, on a dozen plus cable channels, and on 3 streaming services combined. Listen, milestones are fantastic. They mean nothing, though, if they are not backed by revenue growth as far as investors are concerned. Q1, YouTube ad revenues barely crossed double-digit growth on a year-over-year basis, and moreover, they marked a double-digit decline sequentially, which was a concern. Q2, however, was different, with segment registering stronger growth on a year-over-year basis, sequential growth moving into positive territory. Furthermore, management also announced that YouTube Shorts now averages over 200 billion daily views. I'm sure I'm definitely a significant part of that, given the fact I use it just before bed, and it is very difficult to switch it off. Highly addictive, I must add. So certainly I'm contributing to these 200 billion daily views significantly, I think. And the company's AI tools have improved not only recommendations, but also offer features such as auto dubbing, which have increased engagement. Finally, in addition to ads, the company is also focusing on growing the YouTube subscription business, as evidenced by the expansion of its premium light offerings to 15 new countries. Focusing on growing its subscription revenues is certainly the right step in the direction, step in the right direction, in my opinion, especially since in addition to content from independent creators, the platform also plays host to the NFL Sunday Ticket, which costs the company $2 billion annually. Furthermore, companies like WGD and Paramount also offer consumers access to their content inside the YouTube app. As such, in my opinion, YouTube is well positioned to diversify its revenue stream and should certainly capitalize on it. Now, YouTube done, search business done. Next up, Google Cloud. Q2 saw Google Cloud generating strong revenues and margins, further justifying the massive capex spend that Google has been undertaking recently. More specifically, after generating revenue growth of 28.1% year over year in Q1, the segment's revenue growth in Q2 came in at 31.7%. Furthermore, if one looks at the performance sequentially, then Q2 was by far the best quarter ever, as the sequential growth came in at 11.1% compared to 2.6% in Q1. The last time it clocked double-digit sequential growth was in the fourth quarter of FY21, so it's safe to say the company's capex spend is certainly paying off. There was a lot of skepticism among analysts during the Q2 earnings call when management announced the company would be increasing its capex spend by 10 billion to 85 billion for FY25. Management also mentioned that FY26 capex spend would also be higher, which further led analysts to question the timing of the return of investments. Now, I have absolutely no issues with the company's capex spending whatsoever at all. This is because not only is the spending translating into stronger growth for Google Cloud, but it is also helping the company to revamp its search business, as I mentioned earlier. There was certainly a dip in growth in Google Cloud in Q1, which was concerning, but Q2 proved that it was merely a dip and not a trend. Paper ready, pen ready, can only mean one thing: valuation. Let's talk valuation now. Now, this time I did something different. What I did was I deployed a time series forecasting model. More specifically, I deployed an auto-regressive integrated moving average model called ARIMA to forecast Google's EPS in the next 4 quarters. Okay, so let me first do what we're doing. We're doing Google. Okay, ARIMA. Now, the ARIMA model is beneficial for investors for several reasons, such as it's more user-friendly, it has more interpretable coefficients, automatic removal of mean shifting trends, the ability of the model to balance both fit and complexity through information criteria, such as the Akaiki Information Criteria AIC. You don't need to know too much into it. Just need to know it's, I'm deploying a time series forecasting model to get to Google's EPS. Now, Google's EPS data was collected from Alpha Vantage for every fiscal quarter since 2005. In addition to EPS data, items from Google's income statement, balance sheet, and cash flow statement were also collected. After some data cleaning, merging data sets, the final sample consisted of data from 81 quarters. All of this was done in Python, by the way. The model was trained using 78 quarters, with the remaining 3 quarters used for out-of-sample testing. The out-of-sample testing resulted in the following model metrics. Now, I'm going to first write it down. Okay, so the out-of-sample metrics, yeah? So out-of-sample metrics, you have the mean absolute error, 0.430, root mean squared error, which is also 0.430. If the root mean squared error equals the mean absolute error, then it implies that model errors are without any large outliers, which is great. This MAPE is the mean absolute percentage error. That is coming out to be 18.61%. 10 to 20% implies good forecasting. This comes in 18.61. So we're going to maintain the model. Now, given that the metrics, so all these metrics, 0.430 MAE, 0.430 RMSE, that RMSE equal to MAE is good, no large outliers. MAPE is 18.6, 10 to 20 is good. And given that the metrics, so therefore, given the metrics suggest that the model is good for forecasting, the model was then used to project the EPS for the next 4 quarters. This was done by refitting the model on the entire 81 quarter series and then projecting 4 steps ahead from Q3 onwards. Yeah, Q3 2025 all the way to Q2 2026. The projected EPS from the ARIMA model is as follows. So Q3 FY25, Q4 FY25, Q1 FY26, Q2 FY26. Yes. This is going to take a while. Almost done. Right. So we then use the ARIMA model to forecast the next 4 quarters EPS. This is how it stands. On Q3 FY25, it comes down to 296. On Q4 FY26, EPS is expected to be $3. Q1 of FY26, it's $3.14. And Q2 of FY26, it's $3.22. You combine all that up, and EPS for the next 12 months, EPS for the next 12 months comes out to be $12.32. EPS for the next 12 cents, $12.30, which would represent a year-over-year growth of 31.2%, in line with the company's long-term average. Now, according to Alpha Spread, Google's cost of equity is 7.82%. So using this as a discount rate, it results in a present value of this EPS. So PV of the EPS next 12 months comes out to be 11.43. Okay, 11.43 is the PV, present value of EPS. Now, according to Google, according to Seeking Alpha, Google currently trades at a forward price to earnings of 20.8, significantly lower than its 5-year average of 24.3. Now, the ARIMA projections do have limitations, such as ignoring exogenous shocks or failing to account for the evolution of the earnings processes. And as a result of which, there is the risk of overestimating the EPS projections. I have accounted for this risk, and therefore I've assumed a market multiple rather than a 5-year multiple. Of a market multiple is 22.4. So PE, forward PE, I have taken is 22.4x. 22.4x. So now all we got to do is 22.4 multiplied by 11.43, and you get a price target of 256. Which represents about 23% upside from current levels, which is massive, right? Here's what I've done. 22.4, 11.43, 256, the price updated price target, suggesting an upside of 23%. Now, hold on a second. Despite the significant upside, investors will also have to factor in that Google's momentum, stock momentum, is only decent, as evidenced by the short-term momentum grade of B plus and an overall grade of B on Seeking Alpha's momentum scale. As such, I am maintaining my buy rating. I am maintaining my buy rating. And even though I'm maintaining my buy rating on this name, a cost averaging strategy is certainly recommended here, which is any pullback, start with a small position and basically on any pullback, keep adding. Don't just go full guns blazing. Don't make it a concentrated position yet. Now, bull case means we got to discuss the risk factors. The main risk factors to my bull case really remains unchanged, which is the regulatory overhang that continues to be a problem. Next month, the company is likely to hear a judgment related to the trial that challenges Google's monopoly in search and advertising. The company could also lose its exclusivity rights with Apple as a result of this trial, which could significantly impact its top and bottom line. The other risk is the potential timeline with respect to its return on capex. While the company has made significant progress with respect to its AI features, the significant increase in capex spending that is expected to continue well into 2026 does lead to the question as to when the inflection point would be achieved with respect to growth. This is yet another risk factor that investors have to consider and is definitely a risk to my bull case. Bottom line, it was yet another very strong quarter from Google with a beat on both the top and bottom lines. The search business returned to double-digit growth. YouTube saw continued momentum. Biggest standout to me, YouTube saw continued momentum. However, the biggest standout to me was unsurprisingly Google Cloud, whose revenue growth and margin expansion was strong enough to justify the company's massive capex spending. Moreover, its AI investments are starting to pay off, and against all odds, the company's search business continues to remain relevant as ever, even in the age of AI. From a valuation perspective, my ARIMA model projects strong EPS growth in the next 12 months, which makes the company very attractive at current levels. However, given the relatively decent momentum, not so strong momentum, I am maintaining my buy rating on the stock. And while I'm maintaining the buy rating on the stock, I do recommend a cost averaging strategy to get in the name. Q2 was an impressive quarter for Google, but even if investors must take home one key message from the quarter, it is that search continues to be sexy. That's all the time I have for you this week. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttamvinay, UTHAMVINAY, or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening. Like I said, the Stock Doctor podcast now goes on an extended break. So I will see you all in about a month from now. I'm targeting end of September, most likely, when we will celebrate together the show's 4th anniversary. Until then, until the next time we see, stay safe and make some money.